Hey, here's the trading guide with a new one about trading strategies that are based on indicators. Buy here, sell there. It doesn't work. At least when using these indicators alone. Here's an example on the Euro USD 1 hour time frame, and I'm activating here an indicator called the super trend buy sell. I don't want to say that this indicator is bad. But what I want to point out is that you can't rely on the signals like here, the buy signal, without knowing what you are doing, without knowing the basics. For example, when you are buying here at this buy signal, you're losing immediately. You don't know why the signal here is generated, you don't know the algorithm, but definitely the market structure and the trend is not taken into account, and this ends up in a losing trade. Same here, sell signal, perhaps you go for a 1 to 1.5 risk to reward, stop loss to the latest swing high, and boom, you're out. So please don't trust indicators that tell you where to buy and sell, and also no videos or articles that tell you that this indicator is 95% accurate. There's so many indicators out there. We have the EMA, the exponential moving average, then we have the triple exponential moving average, the RSI, then we have the MFI, the money flow index, the ATR, the stochastics, many more. Then you test an indicator, it seems to work, and then you find out in a different situation that it doesn't work anymore, and then you follow a tutorial that tells you to combine certain indicators to a voodoo strategy, and suddenly your chart looks like a colored mess and you don't see the forest for the trees. So where to start? Well, we start with the trading fundamentals. The first one is, for me, the king of everything, market structure. Where are the highs, the lows, and where are these broken? This leads to understanding support and resistance, the key levels of your chart, where price is supported or rejected. You can analyze price directly, for example by understanding Japanese candlesticks and candlestick patterns. If you understood these principles, it's okay to add indicators as well to your chart, but only as a confirmation, not as a base of your strategy. Let me give you an example of market structure before we come to a real trade. This is a line chart of the Euro USD, and here you can clearly see the market structure, how price is moving, the highs and the lows, and this defines the trend. Here we are in an uptrend because we have higher highs and higher lows. This level of the previous high is broken, and then we can see a higher high and a higher low. So this price level could be seen as a resistance that is broken here, and now it acts as a support. If we have higher highs and higher lows, we are in an uptrend and we are looking for buys, not for sells. Because in an uptrend we assume that price is going higher, but we don't want to buy at high prices. So we don't want to buy here or here or here, okay? We try to come into the trade when the price is low at these levels here. When price comes back to this zone, it could bounce off and go higher again. And this is where candlesticks, price action comes into play. I switch from lines to candlesticks that help me to analyze what price is doing. For example, here at the zone of support, I see a candlestick pattern that is known as bullish engulfing. This means the green candle here is completely covering the previous one, the red candle. This tells me that buyers are stepping in, and this is a strong sign to buy here, but only in this context. The context is market structure. We are in an uptrend. We are at a level of potential support, and then we get this nice candlestick formation. In this fundamental context, you can now go ahead and add an indicator as a confirmation of your analysis. I'm using here 3 exponential moving averages, the 8, the 20 and the 200, just to see if price is breaking these, because they can also be seen as a level of resistance. You can also add a second indicator now, like the stochastics or the RSI. For example, to check the stochastics that the market is not overbought, and the RSI momentum indicator is pointing to the upside. But all these things should be used as a confirmation of your basic analysis and should not be traded without the fundamental context. Okay, my friends, I hope I could point this out in a clear way and you understand it, because I can see many beginners switching from indicator to indicator, losing a lot of money. I hope you found this interesting. If you do, then don't forget to subscribe if you haven't already. If you have any questions, add these to the comments below. Ask me anything, I will try to answer as best and soon as I can, and I'll see you soon here on the Trading Guide.